On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. That's another week down. Let's talk about everything that happened, and then let's turn our attention to what's coming up. Right, let's start with global share markets, and it was a pretty tough week for most markets. The S&P 500 in the US fell 4.3%. That's the worst weekly performance we've seen in 18 months. The tech sector was hit hardest. It was down 7.1% as investors became increasingly concerned about the growth picture. And the only two sectors that rose last week in the United States were consumer staples and real estate. Japanese shares also fared quite badly. They were down 4.2%. Europe was 2.8% lower. The FTSE 100 in the UK down 2.3%. The Aussie market held up better than most, down just the 1%. And the local NZX 50 actually bucked the trend. We were up 1.3%. So the only market out of all of those that rose was the little old New Zealand market. There was a couple of major stocks that performed quite well for us last week. Infratil had a very good week. It was up 7.8%. Fisher & Paykel Healthcare was up 5.1%. Mercury was up strongly. So some of those heavyweights did anchor the performance of the local market, but important to remember that one of the reasons that some of those international markets were weak is because of the reaction to the US jobs report that came out during the US trading session, and we were closed by then. So was Australia, actually. So because of that, you might see us play a bit of catch up on Monday morning when we reopen, and we might be down a little bit. Interest rates were down last week as a result of that risk aversion. So you saw US bond yields fall quite sharply. The 10-year Treasury yield fell from 3.9 to 3.7. So it's sitting at the lowest in more than a year. And local interest rates came down too. Our 5-year swap rate fell from 3.75 to 3.6%. So it's now very close to the 2-year lows that we saw about 3 weeks ago. And what that means is that fixed income prices and bond prices actually went up, because when yields go down, prices go up. So even though you had shares that were falling last week, your conservative assets were rising. So if you've got a balanced portfolio and you've got a bit of both, then you would have won on the one hand and lost on the other. So it wasn't a terrible week if you were well diversified. The New Zealand dollar slipped for similar reasons. We tend to go down when there's a bit of nervousness out there, and we tend to go up when there's lots of optimism. Last week there was nervousness, so we fell against the US dollar, the pound, the euro, all down about 1.5% against all of those currencies. The Kiwi dollar was. We were down more against the Japanese yen. We fell about 3.7% against the Japanese yen. Right, to talk to some of those key releases that we saw, and we'll get to the jobs report, which came out late in the week, but it probably was the highest profile release. Earlier last week, though, we had the ISM indices in the United States. You get a manufacturing index and you get a services index from the ISM, which stands for Institute of Supply Management. So these were both for August, and a little disappointing, the manufacturing one at least. The services one wasn't too bad, but the manufacturing ISM, which is closely watched, improved slightly from July levels. So it came up to 47.2, a little below forecast though, and still below that break-even 50 level. And when you look at some of the details, they were also quite disappointing. You had the new orders index fall to 44.6, which was the lowest in 15 months. Services PMI was better. The services ISM index remained easily in expansionary territory, and that expanded marginally to a 3-month high of 51.5. The new orders index for the services sector also increased further. So it did look quite a bit better than than what we saw from its manufacturing sector counterpart, and that did alleviate some of those growth concerns. But the manufacturing ISM continues to look quite weak. Then you had the jobs report later in the week. So this came out on Friday in the US, so it was Saturday morning our time. Definitely points to a weakening labour market. It came in lower than expected in terms of the number of new jobs created. So you had 142,000 new jobs created. That's down from forecast for 165,000. And we also saw downward revisions to the previous 2 months. So when you look at the 3 month average, it's sitting at about 115, 120, I suppose, thousands that is. And that's sitting at the lowest level we've seen since mid 2020. So it did definitely fuel concerns that the economy is slowing more quickly than hoped. In terms of the unemployment rate, better news, arguably. The headline unemployment rate actually fell. It decreased from 4.3 to 4.2. However, the underemployment rate, which is a broader measure of labour market slack, that actually continued to rise. It rose from 7.8 to 7.9, which is the highest since October 2021. So you put all that together and it's kind of a mixed bag depending on which data point or which part of the report you choose to focus on. It's either okay or not too bad or fairly mediocre. So something in it for everybody. I think it does definitely tell us that the slowdown is happening and you are seeing that slowing labour market. So that's really important as we look ahead to next week's Federal Reserve meeting. Here in New Zealand, we've got a fresh look at dairy prices, and the Global Dairy Trade Index, the GDT index, did come down slightly, but only 0.3%, so pretty stable. That was the first decline in 2 months because we have seen some good rises recently. We've seen prices up about 6.5% over the previous 3 auctions. Bit of a mixed performance this time when you look at the different products. Whole milk powder down about 2.5%, but we did see some gains in other areas. The headline GDT index is still up about 11.5% so far this year. Prices hit near 2-year highs in recent months, and they're about 35% higher than what we saw in August last year, which was quite a big slump and prices that fell to the lowest in about 5 years. So not in bad shape. The Fonterra payout is up a little bit. We've also seen a little bit of currency weakness lately. That is helpful because dairy prices are priced in US dollars. As I've mentioned many times, important to note that the farming sector has faced price rises in recent times in terms of the cost base. It's not just interest costs, it's things like wages, input costs. So when we talk about an $8 payout, an $8.50 payout, one of the best we've seen over the last 20, 25 years, remember that $8.50 is not what it was 5 years ago. So that's something to note. There are still some challenges across the sector. Right, looking ahead to this week, and in the US, the key release will be the inflation report for August, the CPI, the Consumer Price Index. This is out on Wednesday, and it will be the last major release ahead of next week's Federal Reserve meeting. So the Fed meets, I think, on Tuesday and Wednesday in the US. We will get the announcement about what they actually do on Thursday morning here in New Zealand. At the moment, markets are very, very sure that we will get that first interest rate cut for the cycle. Most likely a 25 basis point cut, 0.25% down, but there is an outside chance, let's call it 30%, that you'll see a bigger cut, a 50 basis point cut. I don't think they'll do that. I think 25 is what they'll go with, but there is some chance that they might do something more substantial, particularly when you look at those labour market figures. We've had 2 consecutive jobs reports for the last 2 months, for August and for July before that, which were quite a bit weaker than expected. So you never know. They might choose to take some more proactive action. But anyway, markets are expecting this inflation report on Wednesday to support the case for a cut next week, and the headline CPI is expected to slow to 2.6% in August. It was 2.9% last month in July, and that was actually the first sub-3 print that we'd seen since March 2021. So it's expected to come down a little bit further, 2.6% in August. Core inflation expected to be unchanged at 3.2%, which is well down from where it was. So that'll be the key economic release in the US. We'll also be watching the second presidential debate of this year. It'll be the second debate, but the first between Trump and Harris, won't it? Because that first one was obviously between Trump and Biden. The Democrats will be hoping that Kamala Harris performs a lot better than we saw from Joe Biden back in June. But this takes place on Tuesday in the US, Tuesday evening. It'll be 90 minutes long. It's in Philadelphia. I think it's ABC News that are doing it. So New Zealand time, it will be screened at 1 o'clock on Wednesday afternoon. So take note of that. Still looking like a very close race. Harris looks to have the edge at the moment when you look at the betting odds, when you look at the polls, when you look at how they're performing. Harris does have the edge, but anything can happen in politics, and we're less than 2 months out now from the US election. So keep a close eye on this one. I do think it will still be quite a close race, the US election. Across the Atlantic, we have got an ECB meeting, a European Central Bank meeting. So we'll get their monetary policy decision on Thursday night. The ECB was the first of the big central banks to cut interest rates this cycle. They cut in June. Then they paused at their July meeting, and they're expected to resume that easing cycle. So they were at 4% before that June cut. Now they're at 3.75, and they're expected to cut another 25 basis points, which will take them down to 3.5%. We've seen quite good progress on inflation in Europe. The annual inflation rate there fell to 2.2% in August, which is the lowest in more than 3 years. So here in New Zealand, it's 3.3. In the US this week, we're expecting it to come down to 2.6. In Europe, they're at 2.2. So they are highly likely to cut rates again this week. On the local front, we will get the August housing market report from the Real Estate Institute. This is out on Thursday at 9 o'clock. Last month's release reflected a nice rebound in activity, which was much needed because we have seen a pretty weak period, to be honest, for housing market activity. However, prices continue to drift lower. So nationwide sales volumes are up about 15% in July, about 20% from a year ago. So that's good. More listings, more houses changing hands. However, the days to sell did increase, which tells you that there's still a bit of a gap between seller expectations and what buyers are willing to pay. And that did lead to another decline in prices during July. So that's 5 months in a row now that we've seen prices just steadily drift lower. And although national house prices are about 1.6% above their May 2023 lows, that was the trough after those big falls. So we're above that to the tune of about 1.6%, but we're still 2.3% lower year to date in 2024. So house prices still down about 2.5%. However, you would expect that OCR cuts, mortgage rate cuts, will be starting to get people a little bit more excited about taking some action, and first home buyers are hopefully in a better position that they might be able to get into that first home. So that will be an interesting to watch on Thursday as well. A few other things that I won't delve into too deeply. CPI in China on Monday. We've got consumer sentiment across the Tasman. There's an RBA speech across the Tasman too on Wednesday. An RBNZ representative is also giving a speech here on Wednesday. We've got migration in New Zealand. We've got the survey of manufacturing here in New Zealand for the second quarter. That is on Tuesday, and that's really the last piece of the puzzle for the economists trying to get their GDP forecasts organised and finalised. I think the second quarter GDP figures are out next week, actually, so that will be interesting for people to keep an eye on. Also, selected price indexes out on Thursday. That is this new monthly inflation indicator that Stats NZ releases, and it gives you a reasonable heads up about where the quarterly inflation might go, because while it doesn't cover the entire CPI basket, I think it covers sort of 40 odd % of it, and it does cover some of those parts that are quite important. So that'll be closely watched on Thursday as well. Not much happening on the results front, so it's a little bit quiet on the corporate calendar. We have got a Briscoe's result on Wednesday, first half result. Briscoe's always really interesting to watch because they're in such a difficult sector, being retail, which is influenced by the cost of living and how much money people have got to spend and so forth, but incredibly well managed. And they always seem to pull a rabbit out of a hat and keep margins looking good and keep sales growth ticking in the right direction. And they could be benefiting from consumers trading down a little bit. So I wouldn't be surprised if it's another decent result from Briscoe's on Wednesday. Internationally, a couple of things to watch on the corporate front. The one that is of most interest for me will be Adobe on Thursday for their quarterly result. So that's us. Hopefully that is useful. Lots to keep an eye out for as always, and let's hope that the coming week is maybe a little less volatile than last week. All right, thanks team. We'll talk again soon.
For more insights, visit craigsip.com.